Hello and welcome to a stock analysis update for TotalEnergies. Before I do this video, please remember that I do these YouTube videos just for fun as a hobby and always speak to a qualified financial advisor before making any investment decisions. TotalEnergies are the world's sixth largest oil company. They're French but are also listed on the FTSE. In 2022, they achieved 47 billion of positive free cash flow. This was actually the world record amongst all of the oil majors. They've promised around €3 in dividend, which is about a 5% dividend yield. Plus, in 2022, there was an early Christmas present in the form of a €1 special dividend that they paid on top. And in the last couple of quarters, they've been engaging in around 2 billion of share buybacks. They're liquefied natural gas focused since their main strategy came out in 2017. This has put them in a privileged position of being the number one LNG exporter from the US, where gas is the cheapest, and yet the number one importer and regasifier of natural gas into Europe, where gas is the most expensive. So this has put them in an amazing position, which explains why they got the world record for how much cash they made in 2022 in terms of free cash flow. Looking at their 2022 profits, and 42% of that came from their integrated gas, renewables, and power segment, most of that being LNG, 22% in exploration and production, and 29% in refining and chemicals, meaning petrochemicals, with about 7% coming from their marketing and services. Now, one thing that's great about this stock is that whereas a lot of the other oil majors have been flapping around with all of these seismic changes to their portfolios over time, in particular BP, TotalEnergies actually put in place their strategy back in 2017. And they've said that their strategy is going to continue in 2023, the same as it was in 2022. And so looking at the numbers for 2022, from their 47 billion of free cash flow, they have a target of returning 35 to 40% of that to shareholders. So this was 37% in 2022. And as you can see, that meant a 10 billion of dividends with 7 billion going out as share buybacks. They then use about a third of their cash flow to reinvest in the business. Now, according to the strategy, most of that is just maintaining their oil and gas production and exploration at around the same level. But there is then actually a particular focus on boosting the LNG a bit, as well as renewables. And then finally, roughly a third goes into deleveraging. In fact, all of the extra free cash flow they've done after achieving these two targets then goes into deleveraging, which came to 12 billion in 2022. Now they have a vision for where they'll be in 2050, and for the marketing and services segment, which contains in it biogas, they're hoping that although they'll obviously still be doing refining of oil to sell petrol at their service stations, they're saying that 25% of their energy will be e-fuels by then in this segment. They're looking at the majority of their hydrocarbons basically being liquefied natural gas. They're aiming that by 2050, half of their electricity generation will be gas powered and half will be renewables. You can see here in recent years how they've actually increased their gas power throughput, but they're increasing the amount of renewables as well. They plan to reduce their hydrocarbon production by fourfold by 2050, and they're refitting their petrochemical plants with the aim of 2/3 of their plastics being recycled by 2050. We see here their planned oil production, and what we see is that the actual oil production is going to peak in 2025, before then obviously going in a decline to take us to 2050. Whereas the amount of gas is going to be peaking not till 2030 due to their focus on LNG, which you can see they're continually investing in. So to go into details a bit more, and for integrated gas, renewables and power, this is LNG production, transport and sales, biogas and hydrogen, and also their gas power stations and renewable power. From this year onwards, they're going to split this into two segments, one of them being the LNG and the other one being the gas power stations and renewables. The exploration and production, that's oil and gas production and transport. And then refining and chemicals is the refining of these oils into petrol and diesel and other refined products, producing petrochemicals, and also biofuels has been put into this segment. And then they also do a lot of crude and refined trading. And then marketing and services, that's their petrol stations, their natural gas vehicles, which is mainly ships that run on natural gas, and EV charging, as well as lubricants. It gets a bit messy because 85% of the sales from this segment go into are actually inter-segment sales, which they sell to themselves, which is basically a lot of that is selling. So that's selling oil to their oil refineries to then turn into petrol, which they then sell to their marketing and services segment. But it's also oil that they then sell to their own oil traders to then sell to other people. So to show that visually, they produce about 1.2 million barrels per day of crude oil themselves, and 1 million barrels per day of that they then turn into petrol or diesel in their own oil refineries, which then get sold to customers. However, they're also buying about 2.8 billion of crude oil from external suppliers as well. And then this they sell to other people. So they really are quite a big operator on the world oil trading markets. And that's quite a good little diversification for them because this oil trading, it boosts their refining and chemicals business segment. And you can make money from oil trading regardless of if the price is high or low. So that's a nice diversification, as well as the actual fact that they're quite big on refining as well, compared with a lot of the other oil companies. So then when we look at their profit by business segment, in contrast to a more generic company like Shell, where all their money just came from their integrated gas and oil, in terms of TotalEnergies, there's a much nicer diversification. They're less reliant just on the price of oil and gas because they have a much bigger proportion of their profits from their refining and chemical section. They still also obviously did very well in the integrated gas due to their focus on LNG, but also here they have a nice contribution from their gas power stations as well. So they've got ways of here of kind of mitigating against lower oil and gas prices to a small but significant effect. So here we see their profits across their different business segments. And comparing with Shell here, again, we see the dominance of the effective oil and gas price, where most of their money is just coming from the increase in oil and gas price into their integrated gas and upstream segments. Whereas with TotalEnergies, thanks to their gas power stations and thanks to their oil trading and their focus on oil refining, they have a much more diversified income stream here. So this generally makes them look a lot more attractive to me compared with a lot of the other oil stocks. Of course, we also see just how well they've been doing, particularly in recent years, but then also how well they did 2018, 2019, where refining margins were very good. So I'm now going to look at the longer term history for TotalEnergies. And I managed to find, going all the way back to 2017 in this segment from their annual report, their official strategy, which they've kept to doggedly ever since, whereas there's been all these distractions with a lot of the other oil companies. So their official strategy since 2017 was that they were predicting that there was going to be a global electricity and energy shortage. So they decided to focus on selling electricity and liquefied natural gas. with this electricity being sold from both a mixture of their own gas power stations, and they were actually buying up, and they've actually been buying up gas power stations since then, and in renewables. However, importantly, because they identified that there was going to be an energy crisis, rather than like with the other oil companies who were disposing a lot of their assets, TotalEnergies were actually maintaining their oil and gas upstream at the same level. So they've had this long-term strategy where they understood what was going to happen in the energy markets. You know, they ignored all of the popular fashions to quite an extent and didn't like flinch from their strategy. And this is what's put them in this amazing situation now, where they're the number one exporter of LNG from the US, where gas is the cheapest, and the number one regasifier of LNG into Europe, where gas is the most expensive, but also where they're able to take advantage of these sky high electricity prices in Europe. So I really like their strategy that they've kept to, and I think puts them in a great position as far as I'm concerned, the best oil stock I've looked at. For all these new stories, you can look at the first video I did on TotalEnergies, which was in early 2022. Since then, there's been a couple of big things that happened. One obviously was Russia invading Ukraine, but luckily TotalEnergies weren't really all that badly affected by that. Then there's this new story in February 2022 of a 3 billion mega oil discovery in Namibia. Now, TotalEnergies own a lot of acreage here off the coast of Namibia and South Africa. And in this Venus discovery, apparently it really is a massive oil find. It's actually their biggest oil find in 20 years and was the biggest oil find in the world. Now, they need to do more evaluations before they confirm the size. In their recent investor presentation, the CEO said that because of this oil find, they are now channeling 50% of all their exploration budget to the evaluation of this area here. It could be that the additional discoveries are limited, but there's certainly quite some potential here that TotalEnergies really do have some massive assets on their hand, which could be quite significant to their assets or to their oil portfolio overall. So that's like a real nice possibility to have there. It's potentially like an ace in the pack that they have. And in Q3, they had their very triumphant investor call, and and their numbers for 2022 obviously have been fantastic. I mean, you can see how dramatically improved their numbers overall were in 22 from this, but also digging into their raw numbers, they had an absolutely immense 2022, and this was first really apparent in that Q3 call. And they've only just done their full year call. So if you go onto the TotalEnergies website, you can actually watch that presentation. But it's very interesting and valuable information to watch. So I'm just going to go through that presentation and point out just a couple of things worth mentioning. So first, you see how much cash they've got sloshing about here compared with previous years, and you can see how that actually, in terms of net debt, that's been reducing quite significantly thanks to this abundance of cash. And their break even is actually about $25 per barrel. So even though the price of oil has been dropping quite a bit lately, TotalEnergies break even point for oil is down here at $25 a barrel. You know, so it's worth bearing that in mind that they're still actually above break even all the way down here in terms of oil price. We can see here how the price of oil, the price of LNG, particularly in Europe, and refining margins, and as well electricity costs, were much higher in 2022 than in previous years. And there's reason to believe that the price of electricity will only be going higher in Europe because of its crackpot energy policy. And also, then when you think about introducing EV vehicles and things like that, we can actually bank on higher electricity prices in the Europe thanks to the governments that we have. With Russia unable to import refined products, there's good reason to see this. So it's not just oil and gas. In these other areas, which TotalEnergies are fairly strong in, it looks pretty good in the long term. So here there's a nice slide where you have where their cash flow came from and then what they spent it on. So you get like a nice visualization here of how this amount here of 16.3 billion was capital investment according to their strategy, and then this amount goes into their dividends and share buybacks, plus all this, quite a large proportion into debt reduction. So I thought that was quite a nice visualization there. And then in terms of that capex they are reinvesting in the business, you can see that as per their strategy, a lot of it goes into just maintaining what they have. Then there is, however, here some also for new projects, but that again is, as you get ramped down on their existing oil products, they can replace that with new oil. And then here we have their focus on new investment in LNG, and then about a quarter of their investment goes into renewables. Now, this is a very interesting slide where you've got the operating costs of TotalEnergies in terms of dollars per barrel of oil against their peers. And you can see that TotalEnergies have a much more efficient. You see that TotalEnergies produce their oil much more efficiently and profit from the oil much more efficiently than all of their peers. Now, I think I know why that is, which I'll come to later, but all the same, they look much more favourable than the other oil majors from this metric. So when you look at the share price, I think that makes them much more attractively valued than these peers, at least from this metric. So here you see them up against their peers with these different metrics. They basically are looking much more favourable than their peers. The one exception being total shareholder return over a 3-year period, where apparently these were the US majors. And he does a really good talk on liquid natural gas and what happened in Europe during the energy crisis in terms of liquefied natural gas. And if you are a TotalEnergies shareholder, make sure you go and look at this webcast because it really was very interesting what he had to say about this. But just to kind of summarize myself, in 2021, this was the increase in LNG required by Europe because we stopped importing from Russia. And however, we were lucky in a way because of the China lockdowns. There was this reduction in demand from China, and there was also this reduction from the rest of the world, and that was because the price of LNG skyrocketed. So the poorer countries, I think Pakistan is one example, um, they couldn't afford LNG anymore, so they just switched over to burning coal instead. And so this was how LNG demand finished the year. But what we see when we look within European gas is that compared to 2021, as you can see, the amount of gas piped from Russia reduced considerably, but it's still actually quite a lot, 2022. And then that was obviously replaced with LNG. And so what this meant is, whereas in a normal year, the gas tanks would be 54% full, now they're having to be at maximum capacity. He actually said that the reason why the gas price in Europe is so low at the moment is because these gas tanks are full. They literally can't buy more because the storage tanks are full. But that just means there's been a dynamic shift in the LNG market, and so so my interpretation of kind of what he said is that they're going to have to be now keep on buying LNG at times of the year when they wouldn't have done normally because we're relying now on LNG because the Russian pipelines have gone. And in fact, next year there's going to be half the Russian imports than there were this year. So we're going to need more LNG than we actually used this year. So although the price looks really scary at the moment in terms of natural gas in Europe, that's just because the tanks are full. And with these new trends of needing even more LNG next year, plus having to refill all year, it should actually we should see a restoration of the higher gas prices. And the CEO actually he said wait till the second half this year, and we'll have to see. That's why it was very valuable to look at this presentation, because it gives you more information to go on when pondering the gas prices. And a real bonus from watching that presentation, which I hadn't really been aware of otherwise, was there's potential for a €1 special dividend in 2023. TotalEnergies are selling their Canadian oil sands assets, and how they're doing it is they're going to create a standalone company listed on the Canadian Stock Exchange. And when they do that, the money they'll raise, they say they're going to return as a massive dividend for shareholders. And here, another very useful slide, because here's their actual projections for free cash flow next year. And they're saying they're actually expecting $80 per barrel oil. So based on that, 2023 will actually be quite a bumper year for TotalEnergies, fairly similar to the last 2 years. So according to this prediction, according to that, if you believe that, and there's obviously risk there, it's a forward-looking statement, the glory days could still continue yet. And I guess based on what we learned from this slide, it's all down to demand in China, the dynamics of LNG in Europe. So will we see this gas price normalizing again at a higher level than in these previous normal years? So now I'm going to go into each of these business segments in a little bit more detail. So integrated gas and power. And of course, what's great about TotalEnergies is because of what's happened in Russia, there's this now set in new supply chain of Europe having an energy crisis because of its energy policy, and having to now import that LNG mostly from the US into Europe. So TotalEnergies are just perfectly poised here because they are the number one LNG exporter from the US, and then the number one LNG regasifier into Europe. So they really are in a very strong situation here, and they're tactically a lot better off than their competitors. You can see here that according to their strategy that began back in 2017, you can see the ramp up in their LNG sales. And also, they said they'd be focused on power because there was going to be an electricity shortage in Europe, and they've been certainly proven right. And they were actually buying gas power stations, and you see the terawatt hours of gas power increasing. And here you see the increase in renewable power generation. Interestingly, in terms of renewables, they're way ahead of BP and Shell in terms of the amount of renewables they installed. In terms of news flow, the general theme is just continued LNG investments as per their plan. And here you see where they generate much of their LNG, and then where it gets shipped to, and then where it's regasified. And as you can see, in terms of regasification, most of it here is in Europe. So like I say, they really are here in the sweet spot where much of their long-term supply comes from the US, where it's then going to Europe to be gasified. And looking at their renewables, I noticed that actually 80% of their total renewables is solar. and about half of all their renewables are located in India. So this is good to know that at least where they are doing renewables, it tends to be solar panels in really hot places where the sun's shining. Okay, so their exploration and production segment, and you can see as per their strategy, the maintenance of their hydrocarbon production with a shift towards gas and the maintenance of their hydrocarbon reserves. Here we see that the oil comes from all around the world, but they're particularly strong in Africa and the Middle East. And yet most of their oil refineries are in Europe. Now, when I compare them to BP and Shell, BP and Shell, they tend to only have their production in really safe areas of the world where there's not going to be any news headlines. Whereas TotalEnergies have a completely different approach. They're getting their oil from all over the world. And that perhaps is why they're so good at oil trading, because they have this network. And in particular, they've got good connections with Saudi Arabia and that. But in terms of their oil production, and their main parameter seems to be when they go into projects, is it going to be a highly profitable project? They seem to prioritize only going into really profitable projects over worrying so much about the stability of particular areas and what kind of news headlines they're going to be. So it is like this shotgun effect. They have oil projects in all kinds of dirty places of the world, with all kinds of nasty things going on and political uncertainties. And so there is some attrition from this. So the best examples being their Venezuela projects, their Russian projects. But with this shotgun effect, although they do have to suffer some attrition, the oil assets that they're left with include some real humdingers. And this, I think, explains why their operating costs are much lower than their peers. It's because when BP and Shell go bidding for an oil asset, they're competing with each other for these squeaky clean assets, whereas TotalEnergies are going in for these really profitable ones in parts of the world where other people daren't go. In terms of future dangers, though, I've particularly highlighted the Congo, Nigeria, and Kazakhstan. And out of those, I think Nigeria is one where they have quite substantial resources, and there is actually some quite negative news flow there at the moment. So, and some minor insurgencies going on and things. So, for all the overall positives of their strategy, I still have to note Nigeria as a key risk for this company. In terms of exploration and production, there was actually a lot of negative news here to pull out of Myanmar and Russia. There's actually a big war kicking off in Myanmar. So this is their shotgun effect that I've just been talking about. But overall, they do maintain extremely profitable assets. So refining and chemicals, and this is their oil refineries and sales of their refined products, petrochemical productions, biofuels, which is a new thing which they've just lumped into this segment, and crude and refined oil trading. Now you can see that in Europe, now I believe that Europe was getting a lot of its diesel and refined products from Russia. So I think they're benefiting from that, and you can see that with the increase in their refinery throughput. And petrochemicals are generally in decline. Now here we've got the variable cost margin, which is how much money you can make from oil refining. And as you can see, in Europe, it absolutely shot up in 2022. And I expect that's mainly due to what was going on in Russia. So you can see here their earnings and how well they did in 2022. So it really has worked out in the end for TotalEnergies, their focus on maintaining their refining assets, particularly having them in Europe, is good. And we see that most of their oil refineries are in France, although they've got one in the US, one in Belgium, and one in Germany. And it's interesting to see a breakdown of their refined products. Actually, half of it is diesel and heating oils, with gasoline actually less than 20% of the total. This is information on how they make biodiesel. And then also here we have how they're making recycled plastic. And they've got an aim to be 2/3 recycled plastics by 2050. And news flow for refining and chemicals. And actually they've been setting up a couple of new petrochemical plants, which was slightly surprising. Maybe they're more focused towards the recycled. So marketing and services, that's their service station network, their EV charging network, and their natural gas vehicles, which are mainly boats that run on natural gas, as well as lubricants. And you see that most of their sales of these products are actually in Europe, but they also have a big focus in America. But really, most of their refined products seem to be sold in Europe or Africa. And when you look at where their service stations are, there's a large number, 5,000 almost, in Africa. So, that was a bit surprising. Nearly 6,000 in Europe, mostly of which are in France. And it's interesting to see their EV charging network, because obviously only stinking rich people can afford to drive EVs. So it's interesting to see this concentration in Benelux, which is actually one of the most prosperous little regions of Europe. It stands for Belgium, Netherlands, and Luxembourg. They're building the EVs where you get people that own EVs. In terms of news flow, not really much, but I just thought it a bit strange that they bought a BP's retail sales network in Mozambique. So now their profit and loss, and obviously absolutely incredibly good results here. You've seen their sales balloon to 283 to 281 billion in 2022, when a typical number was more around the 200 billion mark. And their net income is now 21 billion in 2022, up from 16 billion in 2021. And this is double the kind of typical numbers we used to see before the energy crisis here. So, I mean, there's just nothing more to say than these are absolutely fantastic results. And they look even better here when I break them down across the business segments. But absolute incredibly good results for TotalEnergies in 2022. Of course, though, we are a little bit fixated on gas and oil price, and if 2019 was their reference okay year, and 2021 is the kind of new normal year, where with the new normal scenario they've kind of doubled from the kind of typical historical numbers with 16 billion, and then with a exceptional year like 2022, we're looking at almost a tripling of the net income. Looking at that, where we are now is still, in terms of natural gas, is still well above the kind of typical year. So we're still looking good now, but obviously we're just very worried about the direction of this trend. And with oil, we're still above this kind of typical year, and still actually above what we were typically in 2021, which was a kind of new normal year, if you like, which we're looking for in the future. But then against that, it's a worrying downtrend, and I'm not going to be totally relaxed until we break out this channel here. In terms of their assets and liabilities, it's very, there's been no seismic changes in this company. You can see the signature of their assets and liabilities remained fairly constant. The only exception being this ramp up in the cash lately. In terms of the debt, it's at 45 billion, and back in 2017 it was only 41 billion. So, although they've obviously considerably reduced their debt in the last few years, I still don't like that number of 45 billion. In terms of their asset composition, I find it still quite hard to understand how oil companies present their assets. Particularly, I kind of was, particularly coming into this, I was expecting that the actual oil in the ground that they have available would be put down as an asset. but it doesn't seem to be valued that way. They have their exploration, production, property, and capex assets here. So there's all the machinery that goes around exploiting oil and then shipping oil, which is quite important. And then also within here, you have, I think, the exploration and production rights, maybe. But the number for the value of all these exploration licenses they have seems to me to be a lot smaller than the value of all the oil that's there to exploit. It was just something I just don't understand about oil stocks. But having said that I don't really fundamentally understand how the assets of oil companies are presented. And if anyone can explain in the comments, please do. But having said that, fairly credible things. So cash is a big segment. Their inventories, which is the oil they've produced but they're yet to sell, plus their accounts receivables, which is their oil which they've sold but they're waiting for the money. The big chunk of this is kind of looks fairly solid, but compared to some other simpler stocks, I'm struggling a bit with this. But nevertheless, if you take their values at face value, then their total assets here of 304 billion, compare them against their liabilities of 189 million. Now, what I do know is that oil companies tend to have lots of liabilities at any given point in time because they run with a lot of current debt and a lot of accounts payables here at 41 billion at any given time, just because of the nature of the business. But still, it's a fairly large liabilities here. But then when we look at the market cap at 128 billion, you can see that that barely nudges over the total assets once we consider the liabilities. So they are, on the face of it here, in terms of the raw actuals, cheaply valued with a price to book of only 0.9. And then when I look at their market capitalization visualization here, we see how in the last few years their net income's gone up a lot, and their revenues have gone up a lot, but their market cap is fairly muted. Now, part of that, despite the share price popping up a bit, is down to their shares in issue because they've been doing these share buybacks, and so we see a reduction in the numbers of shares in issue from 2.6 trillion in 2021 to 2.5 trillion in 2023. That explains this muted market cap. And you have to say, looking at this profile here, that they look very well valued. And when we look at oil stocks generally, they are generally undervalued against other sectors. BP are an anomaly up here because they lost money in 2022, and that's because half their oil reserves and 35% of their equity into as a proportion of their market cap was invested in oil stuff. So that explains BP as an outlier here. Of course, it's not surprising that commodities are better valued than everything else, as tends to happen normally. But it's interesting that the only thing that's cheaper than the commodities at the moment are the banks. So looking at cash flow, and they achieved 48 billion from their operating activities in 2022. Plus, they got in 5 billion from disposals and 3.5 billion miscellaneous. And then they had to shell out 16 billion for capex, 10.5 billion for dividends, and 5 billion paying off debt, plus 4 billion in inorganic growth and 7.3 billion share buybacks. So overall, that led to a 12.8 billion cash gain on the year. So when I take away the things that they don't have to do, we see we have 47 billion of operating activities against the capex that obviously they have to reinvest, and the 10.5 billion of dividends that they've promised. So this leaves them with a 21.2 billion cash gain for 2022, which is a lot of spare money they've got sloshing around. And obviously they've said that they're going to choose to use that to do more share buybacks, but I would like to see them using that to pay off their debt a lot more as well. But nevertheless, this cash flow forecast is exemplary. This company is extremely, extremely healthy. And frankly, even if the oil price did drop considerably, the this company would still be in perfect health, really, looking at the cash flow here. In terms of the shareholders, nothing's actually changed since my last video. It's notable that they have a high percentage of retail investors and also a higher percentage of their own employees own the stock. But other than that, the only shareholder that gets onto the radar by having enough of a whole shareholding is BlackRock. And they were selling a bit, but not in any way that I was able to track since 2021. So looking at the oil and gas sector as a whole, and this sector actually does include coal, but there's not actually any coal left hardly in the UK anymore. So it is now essentially mainly just oil and gas. And I've been using this sector because it's important to look at the sector, because I think it's important to think of the sector overall when to help trade, to help time when to go into, when to leave sectors generally. And we see that the oil and gas sector has generally been within this wide channel over the course of time. What happened was we were at the top of this channel in around 2018, and then we had a contribution of different factors. Probably the most important one that people don't talk about so much is the OPEC shale war. So what happened was the US started producing loads of shale oil, and then the Middle East didn't like this. So OPEC started deliberately overproducing oil to then price out and try and take out of business the US shale oilers. That then obviously led to a collapse of price. But then on top of that, we had the COVID crisis. Plus, on top of that, we had generally the ESG war on oil. So all those three things combined, to me, perfectly explain why we crashed out of this channel and why we were then going to be going rebounding back in. Now, we of course now are in a energy crisis situation. So, but now we're kind of in an environment that people are worried about worldwide recession and stuff. The way I see it, from looking at the actual sector as a whole, this was when I invested in this sector, and I actually started off with by investing in BP. But then when I was worried about Russia potentially invading Ukraine, I sold my BP and switched them into Shell and TotalEnergies. But all the same, really, my investment started down here. And so for me, I've done well already. And really, I'd say I'm approaching the end game. In fact, I'm at the beginning of the end game where I've got to be thinking about exiting this trade. Now, interestingly, when I go to the 5-year scale, we're still within this channel. Even the recent Credit Suisse scare sent us to the bottom of this channel, but then we're rebounding. So we're still safely within this channel. And so I tend to feel inclined to hold on to my oil investments. And only when we break below this channel will I be saying, right, okay, now we're well in the end game. What I really like about TotalEnergies is that they were actually predicting in their annual reports that there was going to be an energy crisis, that there was going to be a shortage of electricity and energy. And so going all the way back to 2017, they've been focusing on LNG and they've been focusing on gas power stations and renewable energy in Europe. I really like how they've stuck to that strategy whilst everyone else is getting distracted. TotalEnergies stuck to that strategy, and that's put them in an amazing position at the moment. Europe seems kind of generally long-term set up for high electricity prices, high refining margins, high gas prices. TotalEnergies actually predicted this back in 2017. They've stuck to their game plan, and they're in this very strong situation right now. And in particular, they're also the number one exporter of LNG from the US, where gas is the cheapest, and the number one gasifier of LNG in Europe, where gas is the most expensive. So I view TotalEnergies very favourably. I'm very impressed with the management of this company over a long period of time. And also we've got the diversification of their profit flows. Unlike Shell, where it just seems to be just totally about the price of oil and gas, with TotalEnergies, they've got a certain amount of hedging there in terms of refining and selling electricity. So yeah, they're doing amazingly well. They seem very good value to me. I think that they're being valued actually just alongside all the other oil majors, but I think they deserve to be valued. But I believe that they deserve a higher pricing than the other oil majors because I think they're fundamentally a much more solid business with their focus in all the right areas and particularly geographically in the right areas. So I'm obviously very positive about TotalEnergies, but a lot hangs on the price of oil and gas. Now, price of oil, it's still actually good. We're still in the new normal sweet spot for TotalEnergies. So if it stays where it is now, it's another bumper year. You know, unless we break out of this trading channel soon, I'll have to really start seriously thinking about whether I reduce my position. Also, natural gas, we're still within the bumper numbers of 2021, but if this trend continues at this rate, we could fairly quickly, within a few months, be back to the 2019 numbers. So, yeah, when you look at the share price in 2019, actually the natural gas prices could still drop quite a lot, and just going on share price alone would still be in a good value. So really, they are still priced fairly good, but how I'd summarise is worldwide recession kind of levels, and the same for natural gas. Then you've got to have a serious rethink about this stock. But for me, I've accepted I'm at the beginning of the end game for my investments in oil and gas stocks, but really the key indicator for me is I'm going to be following this sector trend, and I won't be, and only when we break out of this channel to the downside will I then start being really alarmed. And I'm really actually, if there is some kind of downturn, I'm hoping to actually ride TotalEnergies through the downturn even, because only 13% of my total portfolio is in equity anyway. So I've got a uber defensive portfolio at the moment. And so I've weighed that into my decision making here. I think we're definitely at the beginning of the end game for oil stocks, but I want to see us break out of this channel or going back to 2019 numbers for oil before I start thinking about selling my TotalEnergies offhand. So I've summarized all my conclusions here. That completes my video for TotalEnergies. I hope you found that video useful, and good luck with your own investments. Please read the disclaimer and remember that prices can go down as well as up.